This presentation will focus on China's economy today, including its policies, how China has created this economic situation for itself, and what can be done to improve the current circumstances. First of all, let me start off by describing how China has become one of the biggest exporters of all goods to the rest of the world, predominantly the U.S. In a third world country with so much manpower, cheap labor could never fall short, and especially with a government who doesn't place its concerns on resource depletion or pollution. China has become a country that has attracted so much foreign direct investment into manufacturing all types of products and construction industries. With so much dependency on exporting to other countries, the Chinese government has accumulated so much dollars in its central bank because of its enormous trade surplus of $134 billion, for example, in 2005. Reserves in 2006 amounted to $925 billion and have reached the highest reserve ratio of 13.5%. GDP has increased by 10% for the past few years because of the country's profits from trade. However, with so much people spending less and less and a national savings increase to 50% of GDP in 2005, consumption decreases, which weakens the domestic economy, and the current account surplus increases even more. As less money is spent, less loans are made. In general, people are buying less, so the domestic sector of goods is not profitable and can't grow comparable to the export sector. Now that the world is dependent on China's goods and have even put tariffs on the heavy imports to save their own domestic producers, this increases the price levels in China, also adding to decreased consumption and a stifling domestic economy that cannot afford to buy more imports. As urban minimum wages increase because of furthering social unrest and raw materials and tariffs, production costs have become way too high for manufacturers. Inflation in 2007 has risen by 2.4% at an 11-year high. As briefly introduced, there are many factors of imbalances that have brought China to a present situation of an economic predicament. One main issue that broadly relates all of these factors generally described is through China's fixed exchange rate with the U.S. for the past decade and a half. With so much potential growth for China and its average of over 8% increase in GDP each year over the last 7 years compared to the U.S. GDP average growth rate of under 3%, it seems impractical for China to peg its currency to the U.S. dollar for all this time without any adjustments for appreciation, with one country spending with no limits and the other saving and accumulating dollars at no end. In order to keep the renminbi from appreciating in keeping with the fixed exchange rate, interest rates must be kept down in China, so therefore return on investments are low, which makes savings increase as it has been doing. Of course, as mentioned before, when saving increases, the domestic sector of the economy is generated more slowly. Because the Chinese are not getting as much in return from their savings, there becomes a higher demand for money borrowing, which the Chinese government does not want to provide, to instead increasing reserve ratios and holding onto the dollars. The reason for this decision in not lending to the people is because more money in circulation would cause inflation to increase even more. Also, in order to support the cost of Chinese exports, the government has used the sale of low-return bonds to savers in China. As more Chinese goods are traded, more renminbi must be traded in exchange for more dollars or treasury bonds used for sterilization in order for the foreigners to pay for these goods. In addition, as more Chinese goods are demanded, more renminbi is demanded accordingly, which would already seem as though the renminbi is a higher value currency. Similar to the Chinese savers receiving a small return, the treasury bonds are giving China a small return as well. If the fixed exchange rate were changed to a floating exchange rate, then with an appreciation of the renminbi, the rural areas would be most negatively impacted. Fewer renminbi are required to purchase more goods. Therefore, in rural areas, farmers will have to give up more of their produce in exchange for fewer currency. However, there are still government policies that can be implemented to assist those affected with the loss in providing health care or education. Also, as most of us have observed, the euro and the yen have been getting stronger and stronger than the US dollar. With so much invested in Japan and Europe, but not as heavy as the US, the renminbi's value has only been hindered by the dollar, and once unpegged, should cause the other currencies to weaken and depreciate as it appreciates. At the same time, with greater flexibility, the stronger renminbi would help to balance out the global account imbalances, but the other countries would have to do their part as well in their policies. Japan and Western countries will have to increase their exports, possibly by lowering prices to finally be able to compete with the increasingly priced Chinese goods and supply to their domestic markets. The country that would be most affected would be the U.S. because it is the country that has caused imbalance in trade and current accounts. A reasonable current account deficit should only be half as big as it is now, which makes it unsuitable, and the larger deficit unsustainable, and the larger deficit, a reasonable current account deficit should only be half as big as it is now, which makes it unsustainable, and the larger the deficit, the more the U.S. will have to suffer in a greater depreciation of the dollar and even higher interest rates. Also, with such a high demand from major companies like Walmart for cheap imports from China, Americans will have to put an end to their wasteful lifestyles in debt to lower the account deficit and lessen the effects of the floating exchange rate. While the U.S. economy will take its downfall, so will it bring the rest of the world in a decline, however not as fatal. In order to stay competitive with China, the other Asian economies are reluctant to appreciate their currencies, therefore are experiencing similar issues as China. However, on the positive side, if and when China decides for a floating exchange rate, the Asian currencies will be able to increase their value as well. Not only will changing the fixed exchange rate to flexible affect the global economy, but exporting companies in China will have to target their products on the domestic markets, possibly lower their prices and make less of a profit because of their tougher competition of imports from abroad. It will be a challenge in urban areas during the process of the shift to build more service industries and less manufacturing plants. However, this change would cater to the huge labor supply and create more higher wage jobs, in turn increasing the standard of living and minimizing the income disparity. If the negative effects of the floating exchange rate on the global economy, especially for the U.S. and Chinese exporters, seems to outweigh the long-term benefits, then China should consider a revaluation of the renminbi, increasing its value up to 15 to 25%. In doing so, it would end all expectations of appreciation and capital inflow from international countries, lower inflation, and decreased reserves. The accumulation of reserves is a huge problem that needs to be focused on because as the accumulation becomes larger, so does the problem of inflation, which will act to keep the renminbi undervalued. In a study done by Goldman Sachs, an appreciation of the renminbi would actually have less volatile effects on the deceleration of M2 money supply and the rise of real interest rates. Further, more fiscal policy alone only delays and extends pressure on investments and inflation for so long, in the end not being able to overcome those issues. In brief, whether China goes by the floating exchange rate or the exchange rate is adjusted considerably, the renminbi must be revalued in order for economies and imbalances to fall back in place. In a way, there is a plus in causing a depreciation to the dollar, while other currencies appreciate, in that every 1% depreciation of the dollar, the U.S. current account deficit improves by $10 billion. Even though the revaluation would slow down the growth of the Chinese economy right after, monetary and fiscal policy would still be able to bear the weight of a slight recession.